It's very simple. Get out of cash. If you have money that you're not using next year, later this year, tomorrow, and it doesn't need to be that liquid, if you have a 3-year, 5-year, 7-year time horizon on that pool of money, I want you to consider extending duration. You could do this with treasuries, no problem. You are going to now see rate cuts. You're seeing softening in the data. The rate cuts will be justified. I'm not saying you're going to see some sort of like massive economic turndown, but I think your days of 5.5% yields risk-free are coming to an end. If you look back 5 years from now at a portfolio, the smarter bet will have been to extend those durations, accept less overnight yield.
Josh Brown is urging investors to leave money market funds simply because he believes both bond and stock markets will outperform cash over the next 3 to 5 years. This is his thesis. Softer inflation and softer employment will get the Fed to cut interest rates, which will, number one, lower the earned interest on cash deposits, and number two, fuel the stock and bond markets higher.
$90 billion came into ETFs in May. That is roughly a third of all of the inflows for the year coming in 1 month. Of the $90 billion that went into ETFs, $60 billion went into equities, but $30 billion went into fixed income.
The technicals do support increasing investor flows. We see the S&P pushing to all-time highs, and the bond market is starting to gain momentum. If his thesis is going to play out, we need to see inflation pressures ease. So what does that macro picture look like today? Core inflation is trending lower. Producer prices are normalizing. Supply chain prices have declined. Oil prices have likely peaked. Shelter inflation is falling, and vehicle insurance inflation is finally rolling over. This is all great for the stock market, but the real question is, can growth hold up while inflation continues to ease?
People are traveling like crazy. Look at Las Vegas visitor statistics. Look at auto sales. Who cares about rate cuts? Seriously, it doesn't matter. This economy is strong.